It's Wednesday, 12th of August, 2026. Welcome back to your news update on Blip Brief, crisp, but almost everything updated every market trading day.
Right into it.
Yeah, we are jumping straight into the previous day's market close. And the question on the street today is just this glaring paradox. Like, why is an Indian market that is fundamentally breaking domestic tax collection records, suddenly bleeding capital?
Yeah, it's a massive disconnect.
It is. Indian equity benchmarks ended the session lower, just flashing red across the board. It's continuing this pattern of friction we've been tracking all week. But this friction isn't homegrown, right? We are dealing with an imported anxiety.
Totally. That imported anxiety is hitting us through a very specific dual shock. Look, the domestic market fundamentals might be resilient, but liquidity operates on a global current.
Right. Capital flows where it wants.
Exactly. So first, we are seeing crude oil prices rebounding sharply on the international commodities market. And the second element is, well, that noticeable slump we saw on Wall Street overnight.
Which basically dictates the morning sentiment in Asian markets right off the bat.
It does. It sets the tone completely.
So let's isolate that Wall Street slump for a second, because that feels entirely geopolitical to me. Over the last month or so, global markets had heavily priced in a diplomatic resolution in the Middle East.
Right. They had priced in peace.
Yeah, exactly.
Yeah.
There was this premium built on the assumption of secure supply chains and, predictable energy routes. And that optimism just seems to have evaporated overnight.
Because markets are forward-looking machines. I mean, they price in the future they expect, not the reality of the present.
Right.
So the expectation was stability. But with that diplomatic optimism fading, the forward outlook suddenly includes massive volatility in one of the world's most critical energy corridors.
And when volatility spikes globally, institutional capital just initiates a flight to safety.
Exactly. Capital flows out of emerging market equities and rushes back towards safe haven assets. It's a textbook move.
And that capital flight is, compounded by the oil rebound. Just to break down the mechanics for you listening, whatever global crude surges, it acts as this immediate, unlegislated tax on our entire economy.
A massive tax.
Yeah, it inflates the national import bill, which compresses corporate margins across logistics, manufacturing, and consumer goods. So the street gets incredibly nervous because the cost of doing business just went up overnight.
And that mechanism is precisely why emerging markets are so sensitive to geopolitical energy shocks. But, the fascinating part of today's market landscape is the stark divergence between those global fears and the actual ledger of the Indian government.
Oh, absolutely.
If you look past the imported volatility, the domestic macroeconomic engine is sending out these incredibly powerful signals.
The government's balance sheet is looking genuinely exceptional right now. We just saw net direct tax collections surge by over 23% year on year.
Which is massive.
It is. That kind of jump doesn't just meet the government's budget expectations. I mean, it aggressively beats them.
Yeah, a surge of over 23% is a structural indicator. It tells us two very important things.
Okay, what are they?
First, corporate profitability is highly robust despite global headwinds. And second, formalization or compliance is tightening rapidly. When direct tax revenues outpace budget estimates by that kind of margin, the government suddenly finds itself with immense fiscal headroom.
Right. They have the flexibility to deploy capital for infrastructure rollouts without blowing out their fiscal deficit targets.
Exactly. They get breathing room.
Yeah.
And international rating agencies are clearly reading that exact same ledger.
Yeah. Fitch Ratings just retained India's sovereign credit rating at its lowest investment grade. And crucially, they kept the outlook stable for yet another consecutive year.
Right.
Their rationale explicitly cited a highly robust growth outlook. Combine that with the fact that retail inflation is projected to remain incredibly steady at 4.4%.
Yeah.
So on paper, the macro engine sounds fantastic.
It does look great on paper.
But I have to push back on this narrative.
Okay, let's hear the counter argument.
Looking at this macroeconomic data feels a bit like admiring a pristine, freshly painted vehicle that has a distinct, troubling rattle deep inside the engine block.
That's a good way to put it.
Right. The headline numbers, the taxes, the inflation targeting, the sovereign rating, they all look great. But the granular reality on the ground feels very different. Are the rating agencies simply ignoring the murmurs of distress we are seeing in the actual labor market?
It's a highly relevant pushback. And honestly, if you read the fine print of that same Fitch report, you'll see they are definitely hearing that rattle.
Really? They acknowledged it.
Yeah, they explicitly flagged fiscal risks regarding youth protests over jobs, We have a situation where the broader economy is scaling up rapidly, yet urban unemployment has held completely steady at 6.7%.
Wait, I want to unpack that disconnect. How are companies posting enough profit to pay over 23% more in direct taxes, while urban unemployment is just completely stagnant?
Right.
I mean, we are growing, but we aren't hiring?
Well, we are witnessing a fundamental structural shift in the nature of our economic growth. We are transitioning rapidly from labor-intensive growth to capital-intensive growth.
Okay.
See, in previous decades, if a company grew its revenue by a certain percentage, it had to expand its physical workforce by a correlating percentage. That link has been completely severed.
Because of automation and artificial intelligence?
Entirely. Companies are driving massive operational efficiencies through software, AI, and, automated back office
Oh,
systems.
wow.
Yeah, they are increasing their profit margins, which drives that surge in direct tax collections without expanding their human headcount. They are deploying capital into technology rather than payroll.
So it creates this fascinating, almost dangerous paradox. The sovereign rating is stable because top-line corporate growth is robust, but the socioeconomic foundation is under immense pressure because that growth isn't trickling down into mass urban employment.
Right.
The wealth is concentrating at the institutional level while the ground level feels stagnant.
Exactly. And that tension between outward stability and internal structural friction isn't just a macroeconomic phenomenon. It is actually playing out right now in the most powerful boardrooms in the country.
Oh, corporate India is feeling this too.
Oh, big time. If you look at the corporate news cycle today, it is dominated by how the biggest conglomerates manage their own hidden tensions.
Right, let's start with the Adani Group because they just experienced a massive shift in their structural
You
tension.
definitely did.
A U.S. court has completely dismissed the securities fraud charges against Gautam Adani and his nephew. That just removes a phenomenal legal overhang for the entire conglomerate.
Oh, it's huge. The dismissal of those charges completely rewrites their near-term capital strategy. I mean, when a conglomerate of that scale has international securities fraud charges hovering over it, it forces them into a defensive posture.
Because institutional investors hesitate, right?
Yeah. Exactly. Investors hesitate, debt markets demand a higher risk premium, and international expansion plans are just put on ice. With the courts officially clearing that slate, that risk premium vanishes. You can expect a much more aggressive, forward-looking posture in their global capital allocation now.
So while one major conglomerate gets to breathe a sigh of relief and pivot back to offense, intense turbulence is brewing at another.
Yeah, the contrast is sharp today.
Very sharp. Over at Tata Sons, Chairman N. Chandrasekaran has reportedly discussed internally the possibility of stepping down ahead of their upcoming annual general meeting.
Right.
And this is all due to escalating tensions with Tata trusts. Here is where the governance puzzle gets really interesting. How does a historically well-oiled, highly institutionalized machine like Tata risk such a high-profile leadership crisis at a time of broader market volatility?
Well, the answer lies in the unique legacy architecture of the Tata Group. It is not a standard corporate hierarchy where a board of directors simply answers to a dispersed group of public shareholders.
Right, it's much more complex.
Very. The operating companies answer to the holding company, Tata Sons, and Tata Sons is majority-owned and deeply intertwined with philanthropic entities, the Tata Trusts.
And the current crisis stems from the suspension of one of those key trusts, correct?
When a trust of that magnitude is suspended by regulatory or internal mechanisms, it doesn't just pause their charitable work.
Right.
Because the trusts hold the majority voting power in Tata Sons, a suspended trust severely paralyzes the corporate governance machinery. It complicates voting rights, it muddies quorum requirements, and it throws the fundamental legalities of holding a binding board meeting into question.
So if a trust's operational status is in limbo, the representatives of that trust lose their clear legal mandate. You literally cannot form a legal quorum to pass corporate resolutions.
Exactly.
The structural mechanics are paralyzed.
It demonstrates a brutal lesson in corporate governance. It does not matter how successful the underlying operating companies are or how brilliant the chairman is. If the legacy power dynamics at the holding level intersect with structural or regulatory friction, the entire machine stalls.
Wow.
You have a highly successful corporate leader forced to navigate an incredibly complex web of philanthropic trust structures just to keep the lights on in the boardroom.
It is a stark reminder that legacy structures, initially designed to protect a company, can become a massive liability if they aren't agile enough for the modern market.
Very true.
Now, taking all of this in the global oil shock, the macro paradox of high taxes and stagnant jobs,
Mm.
the boardroom drama at the highest levels, how is the everyday retail investor reacting? Because the data suggests they are drastically changing their playbook.
Yeah, the retail behavior we are seeing right now is revealing a massive shift in risk appetite. Retail investors are noticeably pulling back from traditional diversified institutional routes. In July alone, equity mutual fund inflows plummeted by nearly 15%.
But they aren't exiting the market entirely. Like, they are moving to cash.
No, they are redirecting their capital allocation in a highly aggressive manner.
Well,
Instead of relying on professional mutual fund managers to navigate this macroeconomic volatility, a significant segment of retail investors are making bold, direct contra bets.
meaning they're buying the dip on specific stocks.
Exactly. They're looking at the recent dips in large, fundamentally strong blue chip stocks and buying directly into the weakness.
Okay, let's analyze this strategy, because I have serious reservations. Isn't this just retail arrogance?
It certainly looks like it.
I mean, we are talking about stepping away from the safety net of a diversified portfolio to bottom fish individual crashing stocks.
Hmm.
To me, that doesn't show genuine market sophistication. It shows a dangerous overconfidence. They are looking at a red ticker and assuming it's a discount, without understanding the underlying mechanics of why the stock is falling.
Your skepticism is entirely warranted. While disciplined, long-term systematic investment plans do remain in positive territory, this active bottom fishing in direct equities is incredibly perilous right now.
Right.
And it is dangerous for a very specific structural reason that most retail investors are completely blind to.
What is the mechanical blind spot?
It is the massive wave of post-IPO lock-in expirations looming over the market in the coming weeks. Let's look at the mechanics here. Over the past year, we have seen a frenzy of public listings.
Well, yeah.
When a company IPOs, the founders, the anchor investors, and the early institutional backers are subject to a lock-in period.
Right. The regulatory mechanism designed to prevent insiders from just dumping their entire stake on retail buyers on day one of the listing.
Exactly that mechanism. But those artificial supply constraints are temporary. As we move into the coming weeks, a significant cluster of these lock-in periods are beginning to expire.
Okay.
And when a lock-in expires, a massive flood of fresh institutional supply is suddenly eligible to hit the open market.
Oh, I see. So if a retail investor is busy bottom fishing a stocks because it dropped a few percentage points, assuming it has hit a floor, they are completely misreading the supply-demand dynamic.
They are walking into a trap. Trying to catch a falling stock in a market about to be flooded by post-IPO institutional dumping is like trying to stop a freight train with a tennis racket.
That is a terrifying visual.
But it's true. The sheer volume of sell orders from early investors looking to book profits will simply crush the retail buying power. The bid-ask spread widens, the price floors collapse, and these retail contra-bettors will find their portfolios severely tested.
The lesson there is clear. If you're going to try and catch a market dip, you better understand the cap table and the lock-in schedule, or you will get crushed by institutional supply.
Exactly.
But while retail investors are busy playing these dangerous short-term supply-demand games, the smart money and the government are playing a completely different, much longer game. They're deploying capital directly into technological sovereignty.
Yeah, the policy focus has shifted entirely to future-proofing the industrial base. The government is currently rolling out the ISM 2.0 policy, which is an aggressive move to secure the domestic hardware supply chain.
Right.
They are offering a massive 30% capital subsidy for the semiconductor ecosystem, aiming to boost domestic value addition in chip manufacturing, packaging, and design.
And the timing of this subsidy is critical because it is happening precisely as global AI infrastructure spending is set to nearly double by the year 2026.
Yes, the timing is no accident.
Every major player globally is racing to build the silicon foundation that will power the next generation of artificial intelligence. But I have to ask a structural question about our approach here. Throwing a massive 30% capital subsidy at semiconductor foundries feels a bit like watering a garden with a fire hose.
How so?
Well, do we actually have the legal and structural soil to grow this advanced tech safely?
That is the ultimate question for this decade, and it exposes a massive unpriced risk in our national strategy.
Okay, tell me more.
Legal scholars and risk analysts are sounding the alarm right now. We are heavily subsidizing the hardware that enables AI, but India's physical AI boom is vastly outpacing the legal frameworks required to govern it.
Let's distinguish physical AI from software AI. for you listening, because the stakes are entirely different.
Right.
If a generative AI model hallucinates and writes a bad email, it's a reputational embarrassment.
Right.
But if a physical AI, say an autonomous drone, an automated manufacturing robot, or a self-driving logistics vehicle malfunctions on a factory floor or a public road, we are talking about a completely different scale of physical liability.
The stakes move from digital inconvenience to real-world physical harm and property damage. The core issue is that our existing legal frameworks, particularly tort law and liability law, were fundamentally designed around the concept of human agency.
Right. There's always a person to blame.
Exactly. If a traditional machine causes damage, the legal system initiates a search for the human who breached a duty of care. Was the operator negligent? Was the manufacturer negligent in the design? The law requires a human locus of blame.
But physical AI breaks that paradigm. It is specifically designed to make autonomous decisions in real time based on environmental inputs without human intervention. So if an autonomous system makes a localized choice that results in damage, who do you sue?
Our current legal system has no answer for that. You cannot depose an algorithm. The laws are entirely ill-equipped to handle strict liability when a machine acts outside of explicit human instruction.
Wow.
Until the legal frameworks catch up to establish clear parameters for algorithmic liability, insurance requirements, and safety standards, this entire sector carries a massive systemic risk. We are incentivizing the mass production of autonomous robots, but we haven't written the rules for when those robots inevitably break something.
Is the classic tension of the modern era. The pace of technological innovation moves exponentially, while the pace of legal regulation moves linearly. Investors banking on this hardware boom need to factor in the massive legal liabilities these companies will face when the law finally decides to catch up.
They absolutely do.
Now, speaking of pushing the boundaries of what is possible and rewriting the rules, our final dive today takes us away from silicon chips and human law, directly into the laws of cellular biology.
This one is fascinating.
It really is. We're looking at a medical breakthrough that sounds like it belongs in a science fiction novel, where researchers have developed a new therapy that boosted survival rates against deadly brain cancer by over 50% in mice trials.
And just for context, the statistical significance of a survival boost over 50% is phenomenal, particularly because they were targeting glioblastoma, which is one of the most notoriously aggressive and resilient forms of brain cancer.
Right.
But what makes this innovation a true paradigm shift is not just the efficacy of the drug, but the sheer brilliance of the delivery mechanism.
Right, because they achieve this using a sugar-coated therapy.
Mm.
Now, in virtually every health, diet, or medical discussion, sugar is universally cast as the villain.
Oh, always.
It drives systemic inflammation, it feeds metabolic disease. How does sugar suddenly become the ultimate weapon against a deadly tumor?
By weaponizing the tumor's own biological greed against it.
Okay, how does that work?
The researchers realized that cancer cells are incredibly metabolically active. They are in a state of constant aggressive division and growth. To sustain that kind of rapid expansion, they require a massive, continuous supply of cellular energy, and their primary preferred source of that energy is glucose.
So the tumor cells are essentially the most sugar-hungry entities in the host's body.
Precisely. And that hunger is their greatest vulnerability. The researchers realized they didn't need to force a toxic therapeutic agent through the cancer's external defense mechanisms. They just needed to disguise the bomb as a meal.
Wow.
Yeah, they took the cancer-killing therapeutic agent and coated it in a specific, highly desirable type of sugar. It acts as a biological Trojan horse at the cellular level.
So when this targeted treatment is introduced into the bloodstream, the cancer cells don't recognize the chemical signature of a toxic therapy. They just scan their environment, detect a highly concentrated energy source, and open the gates.
Because of their aggressive metabolic state, the cancer cells rapidly and readily absorb the sugar-coated treatment, pulling the therapeutic payload directly into their core.
That is wild.
Right. Once the package is inside the cell walls, the Trojan horse mechanism breaks down, the therapy is released, and it destroys the malignant cell from the inside out. They bypass the tumor's defenses by tricking the cell's internal logic into inviting the weapon inside.
That is just an incredible application of lateral thinking in bioscience, using the disease's own aggressive consumption as the exact mechanism for its destruction.
It really is.
We aren't just trying to blast the tumor with radiation from the outside. We are actively manipulating its biological programming.
And if we pull back and look at the broader theme of our discussion today, it leaves us with a profound thought to consider. We spent the first half of this deep dive talking about engineering artificial intelligence to think autonomously, and now we are talking about designing medicines to actively trick our own cellular biology.
Right, it's all about mimicking systems.
Exactly. The biggest leaps in the coming decade won't just be measured by what raw technology can achieve. The true revolution, the one that will redefine both our economy and our health, will be in how perfectly our technology can mimic the fundamental logic of biology.
And just before you go, a quick note. This deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most.
The content shared here is for informational and educational purposes only and should not be treated as investment or trading advice. Past performance is not indicative of future returns. We are not licensed financial advisors.